improvement in asset quality. But what I found to be most interesting when I have this conversation with banks is now to understand from a provisioning standpoint, how do you look like in terms of the stage 1 versus stage 2 versus stage 3? Because granted, we do anticipate that the asset quality will be improving over time unless something really extraneous happens. But in terms of how you are perceiving that risk that you already hold in a very disaggregated fashion in terms of stage 1, stage 2, stage 3, how would you say you are looking from that standpoint, Abraham?
Our experience is that the new loans we are booking are performing much better. And the reason being that a lot of our customers who are coming for new debt have some level of confidence of their ability to sustain their obligations. And also, because banks have tightened their risk parameters, their choice to lend is more skewed towards a higher level of confidence on ability to pay. So the new book that we are booking is behaving quite well. Okay. Now, if we then move to stage 2 loans, which are loans that have kind of moved into arrears, that is where you are seeing some level of accommodation, especially in the sectors that are vulnerable to the health restrictions. So sectors such as transport, sectors such as hospitality are sectors where you would have some form of accommodation in between. And most of those customers are kind of lying in the stage 2 area. Our experience for those loans is that with the right level of accommodation, our customers have started servicing that debt in some form of or another. Now, stage 3 is NPLs. What we have seen is that our NPLs have actually gone down. So the level of provisioning there directionally will be coming down year on year. For stage 1, which really has the loan book that is performing and it's not in arrears, the incremental provision is quite low. So I would say the credit loss ratio for stage 1 type loans is almost 0.83. And how do we calculate that credit loss ratio is what you book in the balance sheet vis-a-vis the loan book. So your credit impairment charge divided by the loan book. Then if you move to stage 2, your credit loss ratio now ticks up to almost something about 1.5%. Then if we move to stage 3, the loans become, the provision becomes much more scientific because you have to look at how much would you actually lose.
Still on the issue of asset quality, where were the bulk of your recoveries coming from? Because you look like you had some bit of aggressive recoveries in the last this half.
Yeah, a lot of recoveries were from personal households, and a lot of them is really as a result of some level of rebound. Most organizations that employed people, first of all, started with maybe a 50% pay cut to maybe a 75% pay cut. Now, with resumption of economic activity, most of them are now moving back to some level of either 50 or 75% resumption in pay. And we are seeing most of these customers now starting to service their debt. We have seen some slowness in ability to realize collateral because the demand for things like houses in terms of secondary purchases has declined because the general economy is still trying to recover. So a lot of the recoveries are actually coming out as a result of our customers finding either alternative sources of income or resuming in terms of their current jobs.
We've had this discussion with you before, maybe just an update. Have you, as a bank, received any guidance from CBK regarding the risk pricing in view of the prevailing circumstances?
Yeah, we've had we've had very healthy engagements with the Central Bank of Kenya on risk-based pricing, and we actually do appreciate the fact that they are challenging our models and our thinking, but they are also picking up some of the insights we are giving them around how we approach pricing. The engagements with the Central Bank of Kenya are actually almost in the final stages for us to kind of get the overarching no objection for the methodology we have. Central Bank has been quite accommodative in providing us with specific approvals where we are seeking specific product approvals, but we would like to kind of agree with them an overarching methodology so that it allows us to respond faster to the changing customer needs by just applying the principles that we've agreed with them. So the engagements are still ongoing, but I would have to say they were quite healthy. Yeah.
Here's the way I've looked at it. Vis-a-vis H1 last year, pretty good. But when I disaggregate now the current H121 into Q1 and Q2, it looks to me like Q2 was not as strong as Q1. I could give you an example of the net earnings, for instance. If you consider that 1.9 came from Q1, it tells you only 1.6 came from Q2. Is that a fair assessment? And what drove this relative slowdown in Q2?
So that's fair, and I think it also does need to reflect the nature of our business. One is that sometimes you have cycles where you have dips in revenues that are not necessarily annuity revenues. Specifically is investment banking fees that are not necessarily annuity. So you would have quarters where you do book higher investment banking fees revenues and quarters where that is not the case. I think the important thing is to kind of look at your earnings in the context of the annuity piece, and the annuity piece being net interest income, kind of showing almost consistent growth. But also, if you then move also on the cost side, you would expect that a lot of the activities start building up as you go through the year, and the first quarter of the year is normally quite slow in terms of activity from an investment point of view. So there is also usually a slight uptick in the second quarter, but you would also see while you go back into the third and fourth quarters, the comparatives will actually show you that there's also a slowdown while you go towards the end, because again, December, October, November, December, there's also a slowdown in terms of activity from a cost perspective. So we do understand those cycles, and those cycles are not necessarily very different. If you look at the cycle for 2020, you would almost see the same. Very strong first quarter, slowdown in the second quarter, uptick in the third quarter, and then slowdown in the fourth quarter.
Fantastic. Let's move to your securities business, SBG. If you look at the market right now, volumes are quite thin, nothing quite exciting happening. But we've seen Stanbic get some very interesting business by way of advisory, whether it's the green bond or whatever it is. Are you getting some interesting requests? What's your pipeline looking like?
Yeah, the pipeline is quite quite good, and it does reflect some level of optimism across the economy. I think there is still very good interest among foreign investors in Kenya as an economy, largely because of the free nature and the level of opportunity, and also the level of digital adoption in this economy. This is an economy where you can test new things and you will get honest feedback around levels of adoption. But we are also supporting government in their Big Four agenda. And part of the pipeline we also see is how best we can support government in their various infrastructure projects by us also advising government as the same way supporting the private sector. Yeah, so the pipeline looks quite healthy.
Sudan. And from a risk position, and especially with regard to FX risk, how is that looking?
Yeah, the currency in South Sudan has now been floated for various years. The currency was quasi controlled. I think we are seeing the IMF resuming some level of support the economy in South Sudan, which then does point to some stability in the currency in South Sudan. Specifically for us, our book in South Sudan is largely dollarized, so we've significantly mitigated any foreign exchange risk in South Sudan. But we do expect that currency will stabilize and achieve some level of normalcy around its price relative to hard currency.